This video is all about inventory adjustments, how accounts keep track of inventory, calculate variances, and record inventory adjustments. Let's kick things off though with a quick scenario. Imagine you're running a clothing store and you've just sold your last shirt for the day. Now, when you close up shop and review your books, you'll see that the merchandise inventory account in your accounting records shows the same amount as when you started, even though you've sold tons of shirts. What do you think happened? That's because under the periodic inventory system, the merchandise inventory account is only updated at the end of the period, not every time a sale happens. All purchases are added to the purchases account. It's like using a bank account to track your spending, but only checking your balance once every month. So at the end of the month, it's time to figure out what you actually have in stock. That's when we start the process of adjusting our inventory. And trust me, it's important to get it right. Your financials depend on it. You can probably already tell that this inventory system, which is called periodic because you periodically count your inventory, can be challenging when you have a lot of inventory because you never know what you have in stock unless you physically count the inventory. Larger businesses or businesses with a lot of inventory often prefer to use the perpetual method of inventory. And by the way, it's called perpetual because you probably guessed it, perpetually or constantly track your inventory. It's expensive though to use the perpetual inventory method because you need all kinds of systems in place to track your purchases and your sales. That's why most small companies use the periodic inventory system, meaning you record all purchases to the purchases account and periodically count your inventory. So let's talk about counting inventory. The first decision is how frequently you'll count your inventory. Is it going to be monthly, quarterly, or annually? Plus, you need a strategy. When will you be counting inventory? Like, for instance, at night or the weekend? Keep in mind that you can't count while you're still open for business. Otherwise, it will get confusing really quickly. Will you hire people to help with the inventory count? If you're using outside contractors, you'll have to consider that there aren't that many companies that do inventory counts, so you may have to plan in advance to ensure that you have the right staffing. Is the warehouse organized in a way that all inventory can be located easily? I remember working for a t-shirt design company in the 1990s where the owner knew exactly where every design was in the warehouse, but everyone else needed to specifically look at the signage on the rows and the numbers on each shelf and box. In short, you need to plan for the inventory and make sure that everyone is on the same page. And on the day of the inventory count, the job is to count every single item and calculate its value. So wait, how do you determine the value of the inventory? Well, there's the FIFO method, where the first items bought are the first items sold. And then there's the LIFO method, where the last ones bought are the first ones out the door. Some businesses use barcode scanners to help with the count. But even with technology, it's still up to you to ensure everything adds up. Because one tiny miscount could lead to a big surprise at the end of the period. And that's why many companies team up 2 people for every inventory count to ensure that the count is right. One thing that's likely going to happen during an inventory count is a variance. For instance, you counted all your inventory, but something's off. Maybe you expected 51 shirts from the brand XYZ, but the count says 48, a difference or variance of 3. And you know that you received a shipment of 70 XYZ shirts just a week ago and you only sold 19. So there should still be 51. What now? A few things could have happened. First, did you really receive a shipment of 70 shirts or was it really 67? Then, did you track all the sales correctly? And was the inventory count correct? You'd want to check your documents and probably want to do a recount just to be sure. Keep in mind that someone might have moved some of the shirts to a different location. Rather than in the warehouse, they're displayed in the store. But let's say you really received 70. Your sales tracking is accurate and the inventory count is accurate. That means that you have a real variance of 3 shirts. A discrepancy between expected and actual inventories is not unusual, but it's important to figure out why. In a retail store, there's a certain level of theft, or you could potentially also have damaged goods. One tool accountants use to investigate variances is the inventory roll forward method. It's like retracing your steps. You start from the last count, add new purchases, and subtract the sales. This helps to see where things might have gone astray. But don't panic. A variance is an opportunity to learn. Was there an error in a recording? Did an item get misplaced? Tracking down these inconsistencies is a detective mission. And as accountants, we're pretty good at solving mysteries. Now comes the fun part, adjusting the books to reflect the new inventory balance. We do that in 2 steps. The first step is to remove the old inventory balance that's been on the books since the last inventory count. Think of it like clearing off the table before you start a new project. So we debit the income summary account and credit the merchandise inventory. After recording this entry, our merchandise inventory account should be 0. As part of step 2, we bring in the ending inventory to update the account with what you actually have. We debit merchandise inventory and credit income summary. It's like hitting refresh to make sure your records are current and accurate. In the end, these adjustments ensure that your books match the real world. Let's look at 2 examples. First example, the beginning inventory is 125,000 and the ending inventory is 106,119. To record this entry, we first remove the beginning inventory to income summary by debiting income summary for 125,000 and crediting merchandise inventory for 125,000. Then we debit merchandise inventory for 106,119 and credit income summary for 106,119. That means that the merchandise inventory account now shows an amount of 106,119, which is the accurate ending inventory. What about the income summary account? It shows an amount of 18,881, which represents the inventory adjustment to reduce our merchandise inventory of 125,000 at the beginning of the year to 106,119 at the end of the year. The second example is nearly identical except for the amounts. In this case, the beginning inventory was 198,327 and the ending inventory is 152,159. The first step is to remove the beginning inventory to income summary by debiting income summary for 198,327 and crediting merchandise inventory for 198,327. Then we debit merchandise inventory for 152,159 and credit income summary for 152,159. Our merchandise inventory account now reflects the ending inventory of 152,159 and the income summary shows us the inventory adjustment of 45,168. The difference between beginning and the ending inventory. Our examples here are pretty straightforward. In many companies, the inventory adjustments might be recorded by category of inventory. For instance, there's a merchandise inventory account for shirts and another inventory account for pants and another one for shoes. It can definitely get really complicated. Hope you found this video about the periodic inventory method, the inventory count variances, and inventory adjustments helpful.